Good morning, Wall Street Reporter. This is Andrew Packer coming at you again here on Martin Luther King Jr. Day. Yes, the stock market is closed, but there's still a lot of work going on, and a lot of people in finance are just continuing to treat this like any other workday. Joining us today to talk about some of the macroeconomic issues that are facing us in 2021, and really kind of a more interesting way on sort of how to be a better trader, which is an incredibly, critically important thing, especially in these markets that are probably going to get a little more volatile before they aren't. Joining me is Rick Bensignor. Rick has had an illustrious career, Morgan Stanley, Wells Fargo, Bloomberg. He's been a floor trader, got some great stories there. So I'll just kick this off right away. How are you, Rick?
I'm good, Andrew. Thanks for having me.
Yeah, so let's actually just start with kind of your time on floor trading, because that is going away. It's all getting computerized. Just kind of maybe give people just sort of an idea. Is it sort of that like action-packed sequence they always show in finance movies?
Yeah, it pains my heart that the floor has disappeared, but you can't argue with the revolution in just technology of making things theoretically more efficient. I mean, the floor was actually an incredibly efficient way of price discovery happening. But I guess computers that can do things in a fraction of a second, instead of having a phone call down to the floor, a clerk writing up the order, running it into the pit, the broker reading it and trying to do that, which obviously took more time, doing things in nanoseconds, I guess is more efficient. But the floor was a tremendous place to learn the markets. I spent the first 12 years of my career on the floor and trading a variety of different commodities and stock indexes. And I think the value of what you learn on the floor is it's unbeatable. There's no desk job. You can even sit on a trading floor at a sell-side firm, but what you're going to learn is still very different and not as much as actually being on the floor of the exchange where the actual price discovery occurs. So that's gone.
Always something to be said for experience. And now, instead of having, here's a paper slip that takes 3 or 4 days to kind of fully settle, it's just a trader can be in and out. And now you have a lot of firms that are just trying to like scalp trades in nanoseconds.
Sure.
And it's sped up just so much that there isn't necessarily even room for a human being in a lot of ways. But the flip side of that is, if everyone's looking to make these tiny trades in the span of microseconds, there's a room for traders in there who are just looking for hourly, daily, even weekly moves. So
sure, short-term trading has become far more prominent. What I'm not a big fan of is these high-frequency traders who literally can be in nanoseconds and can front other customer orders, which is really what they're doing often. But as long as the exchanges support the idea and the exchanges get paid a lot of money from them, so the exchanges are for this, it's a big revenue producer for the exchanges, and the exchanges are all public companies, it's not going to go away. So we have to, as individual traders, we have to understand that, often your order, even if it's for 25 shares of a stock, is probably going to be fronted by some computer for the tiniest fraction of a penny, and that's just life. But if we're playing for swing trading, a few weeks to months, that's the way you can beat the computers, is because they don't really care about trend. They're in and out so quickly, so you exploit them by playing trend.
Right, and I mean, my understanding is the computers basically, they're looking at the market orders basically live, much faster than a human being can process, and they're just looking for these opportunities just to make these very tiny amounts, but then multiply it by millions of shares a day. So you might pay like a fraction of a penny more for a trade than you would have, and maybe you don't notice that something costs an extra $1 or $2 a year, but multiply that by every trader out there, and the firm on the other side is just making some
absolutely. It's a money press for those high frequency traders.
And I mean, I'm not sure kind of how that ends, or if that can create some sort of problems, sort of like the 2010 flash crash. But at some point, there's probably going to be some countervailing issue that kind of reins that in. But
yeah, I would think at some point there is something that, or someone will come up with even a better idea of how to either squash them from doing it, or fronting them is not going to be the answer, because that just creates more of the problem. But yeah, it's an issue that it's not going to affect the average person. in any material way. But yes, when you do it thousands of times a day over every trading day of the year, it's a money machine for those type firms.
Absolutely. But
Yeah.
let's talk trading. You are a trader. You use a lot of technical analysis, but you have sort of your own take on it and why it doesn't what doesn't work traditionally, and how to fix that. So let's talk a little bit about your strategy.
Yeah, so I'm now just past 40 years in the street and having experience both on the trading floor, sell side and buy side. So I kind of have that perfect trifecta of experience and understand each side of the business because I've been in each role. What I realized probably back in the late 80s, early 90s was that if you play the game from whichever one of those roles, the same way the average person does, you'll never do better than average because you're all playing. Well, think of it this way. If you have a bell-shaped curve of profit versus loss, the first standard deviation in the middle is essentially the average return. 70% of people are going to fall into the fat part of the curve, which is considered average. You could be slightly above average or slightly below average, but you're going to be in the average place. The best way to make money on the street, if you have the tools and the wherewithal to do it, is to play in the second and third standard deviations of price activity. So let me give you an example. If a stock went from 50 up to 100, pulls back to 80, rallies again to test the high, let's say stops at 97, and breaks back down under 80, most technicians on the street are going to say, oh, double top, we took out the interim low, it's a sell. And they'd probably be correct. The problem is, by the time they identified that classic pattern, you're 15 to 20% off the high of the move. Let's say that also occurred at the bottom when a stock is basing and it makes a W type pattern. When it breaks the middle of the W towards the upside, it's a buy because now you have a clear double bottom. But you've also probably missed 15 to 20% of the move before you identify that. So if you miss 15 to 20% on the bottom before you're bullish, and you miss 15 to 20% off the high before you're bearish, that kind of puts you in the fat part of the bell curve of price activity. You'll capture 70%, and that's good, but so is everybody else. So if you're an individual trader, that's not a concern because you're just making the goal of an individual trader is to make money. But if you're a buy-side firm, if you're just an average player, why should assets come to you? If somebody does better than you, that hedge fund or mutual fund is going to probably gather more assets. Being average is not good enough. You have to beat the benchmark return, or you have to be better than average. So what I do is figured out ways to play in the second and third standard deviations. In other words, the tails, the levels at which we can identify price exhaustion to a trend, switch from being bullish to bearish before it's evident to everybody else. So if we go back to the example I gave you, that would maybe have me selling near, let's just say 94, instead of it breaking under 80 before I got bearish, or buying at a price of, let's say if a stock went all the way down to 0, which it wouldn't, but let's just use that.
Okay.
Let's say paying $5 to get long instead of waiting for it to get above 15 or 20 before I got long. So doing that is obviously quite difficult. It's probably the toughest thing you can do with consistency. But through the models I've either developed myself or had access to from a long time ago, 25 years ago, I came across some models that fit into this idea of playing for trend exhaustion, properly positioning yourself for a trend to end way before people realize it. And sometimes you take some pain because you've stepped in front of a running train before it's quite ready to stop. But if you know how to manage risk and where your idea was wrong to have gotten in front of that train, so you lose a small amount because that train kept going, but when you're right, you're now positioned way ahead of before other people realizing that a trend is turning. And that's how I so consistently buy very near the lows of moves, both for my personal account and for the institutions and the newsletters that I write for institutions.
Right.
And it's how we get in front of the moves in order to properly position for the next move before you've given up so much and everybody else sees the same thing.
And what kind of trends are you specifically looking at? Because I know some traders who will say, oh, these volume trends make sense. Or you might have people who say something like RSI or moving averages, not necessarily the same ones everyone else is looking at, make sense.
Right.
Like, what are you looking at that's different?
Well, so I'll look at most charts I put up will have, your basic bar chart or candle. I can read a bar chart and know what the candle is anyway, so it's not important to me. Sometimes because candles actually take up more width on the chart, you often have less room to be able to easily see it. So most of the time I've got a bar chart. I usually have, let's say, MACD running on the bottom because I like MACD. It serves a dual purpose of both momentum and actually can signal the crossover. So it's in theory both a moving average crossover and a momentum signal. But the rest of the tools I use are fairly, let's say, non-typical type studies, and those that many people don't really know how to use. So what I don't typically use is, let's say, RSI or stochastics. To me, using RSI and thinking that you're going to consistently make money off of an RSI overbought or oversold signal is foolish unless you have a complete sideways trend. So if the market's going nowhere, often your buy and sell signals with RSI will line up to the peaks or close to the peaks and the troughs in the market. So any sense of trend, RSI is going to get overbought, and you're going to be looking to get out of something that could easily double or triple from when it first got overbought. And there's such a good amount of time that markets do trend that, to me, the people who think RSI is the heavenly answer of how to make money, I just think you're not going to make money with it, and in fact, it's going to cost you a significant amount of money that you could have had. So I put RSI and those kind of similar type things in a very tertiary role. It's certainly not primary. It's not even secondary to me. What I do care a lot about is Ichimoku, the cloud charts, and the institutional community knows me as the person who most brought cloud charts to the United States and also taught institutional traders how to use them. The books and reference material on Ichimoku, the mathematical calculations everybody has right because it's a simple stated mathematical calculation. The interpretation in most books is not correct. And I've had 3 publishers come to me to actually write the definitive book, and I choose not to because it's a real competitive advantage to actually understand how to truly use this model. And all the people who use it who think they know how to use it is actually something that I myself can exploit. I also am a big fan of models by Tom DeMark, and I will never trade or put on a position without seeing where some of his key models are suggesting where you are in a trend. And the last thing I want to do is buy when we have a trend exhaustion signal that if you don't know how to use these models, you would buy in something moving higher that looks like it's going to keep going. So his models are unique in the sense that they can help identify the exhaustion point to a trend as close to the trend's exhaustion point itself, better than, in my opinion, any other individual or group of models out there.
And I think that's a key point in a lot of ways, because what are you looking for in a trade? You want to know when to get out, and you want to have a good sell signal, and knowing when to sell is one of the hardest parts of investing.
That's what most people will tell me. I also write individual investor newsletter through inthenowtrader.com, which I started a couple of years ago to give individual investors access to my interpretation of models that they've never seen before and what institutions rely on. There's very few people who have taken institutional models and brought it to the public. The institutional models and the community generally stays fairly tight-knit. Once I kind of left the street and working for sell-side or buy-side firms and went on my own and created Bensignor Investment Strategies, which is my institutional consulting firm, and In the Know Trader, which is the individual investor firm, I realized, why not give individuals access to models that really help identify things that they couldn't identify themselves. And I've had a terrific track record. So in the 4 years that I've been doing my institutional newsletter, I have beaten the S&P every year, and by a factor of over the 4 years, the average annual return for the trades I suggest has outperformed the S&P by 3.8 times on an annual basis. So the S&P is up an average of 15% the last 4 years. We're up over 55% the last 4 years. So
I mean, that's a fantastic, beat, especially if you're just focusing on those S&P 500
sure.
type companies and the advantages.
Sure. So and to compile that return, I'm not trying to be a portfolio manager benchmark to the S&P in the sense that we'll trade commodities. We'll trade, I'll put out recommendations from foreign exchange. I'll play the 4 asset classes, but collectively, the return on capital of the ideas that I formally put out in a newsletter. And I should say this to you too and your listeners, because there's so much misinformation and kind of lying that goes on in the industry. And people will pump up their track record to say, look, I told you to do that. So here's an example that kind of irks me, but so many people do in order to make their results look good. You say, let's say you're bullish gold, and gold moves up. And then you say, we told you to have bought gold 2 weeks ago. Well, if you didn't tell me what price to have bought gold at, where's my target and where's my sell stop, you didn't tell, it means nothing to me. That's not an official recommendation. You can't just say I'm bullish something, and then if it goes up, you take the credit for it, and if it goes down, you never write about it again for the next 3 months. You have to put out official buy levels, sell stops, and targets. And then you can each week write about those and adjust them as necessary. But unless you do that, you can't take credit for saying, I told you to do something. So the difference is we track every trade that we tell you, here's where you get in, here's where you get out, here's your stop. Those recommendations is what has collectively come up with a 55% return each year for 4 years running.
I mean, that's great. And I mean, I come from a background with financial newsletter publishing where like a lot of the marketing can sort of try to really tweak those numbers to an extreme level. And
I've had so many of these companies come to me and want to market my newsletter. And each and every time I end up turning them down because I kind of get the sense that there's a unprofessional side of the marketing that goes on that, I sometimes get in the mail, you might too, and I don't mean email like snail mail, some 14-page glossy, almost like magazine thing about some person you've never heard of, and they go on for 14 pages of why you should subscribe to them that aren't true, and people fall for this. So I prefer not to go and have tens of thousands of subscribers and ruin the name and reputation that I so carefully built over all my years on Wall Street. So I have less clients than these people do. I probably make less money than they do, but I can sleep at night and have integrity that what I'm doing is really done for the intent of helping people make more money than they could if they weren't listening to me. And that to me is the most important contribution I can make to people. Take 40 years of experience and share how to do it and play the game the right way.
And I mean, that's a valuable addition. So looking at some of your indicators, are there any kind of surprises that people might be surprised if you were saying, oh, the stock market looks like it might be exhausting soon, or, everyone wants to kind of be in gold right now on inflation fears. Maybe that's actually not a good trend. Like what are you seeing with, kind of your way of looking technically at the markets that might be surprising?
So I'd say the biggest one that I'm out of consensus with is the dollar. The biggest macro consensus trade across strategists and economists going into 2021 is how weak the dollar will get. And some are incredibly bearish. I cautioned clients in December and already in early January to start covering shorts in the dollar. And I don't think the dollar necessarily made the low for the year a week or two ago, but I think that using the dollar index as an example, we might get down to 87.5, but and it's trading 91ish right now with a low at 89 and change, let's say a week ago or 2 weeks ago. In 2016, late 2016, when President-elect Trump became the president-elect in November, the dollar surged higher and ran straight up right into December 31st close. And the biggest consensus macro idea for 2017 is that the dollar would rally sharply. It peaked the first day of trading on January 2nd or 3rd, whatever the first day was in 2017, and closed and sold straight off of the year, almost closing on the low of the year. The biggest consensus trade was 100% wrong. I'm fearful that this year could potentially be similar because so many strategists and economists think the dollar is going to get blasted this year. And I recently got some downside exhaustion signals. Actually, the level we gave clients was 89.23 in the dollar. And I believe the low is 89.20. And now it's up at 91. Now, it's only a couple percent, but in the
Right.
US dollar terms, a couple percent is already significant. It could easily get to 93 to 95 because just on a short squeeze without much changing. And as I said, I could see it coming back and getting down to 87.5-ish. But unless it really breaks 87.5, give or take, a finite amount, which I'll figure out at the time, this could be the biggest blow up trade again for people who are just positioned the wrong way. So I've already instructed those who are trading the dollar to cover shorts, and if anything, play the long side with a tight stop, but we've already got some profit on the upside here. And for bigger macro people, you could be prepared to see the dollar still rally further before it's going to run into more significant resistance and sellers coming in. But right here, if I had to choose one way, I'd rather actually be long the dollar than short. It's a totally out of consensus trade. But
I mean, it's
those are the
interesting you
ones
say
that
that.
usually
Yeah.
make you the most money.
Right. And I mean, we've had a number of people who said, this trade has gotten sort of lopsided. So just from a contrarian standpoint, you kind of want to take the other side of the trade. But if the technicals are starting to match kind of, that intuitive, contrarian kind of view also, that could be a pretty big move. And obviously for retail investors who might not be trading Forex, if the dollar is going up, usually all things being equal, the stock market's going to be coming a little off kind of its frothy highs. Some of these other risk-on assets, gold
and the metals.
Yeah.
Well, that's the big thing is how many people are in gold. Last summer, I actually called the high in gold a week after it was made. I suggested that would be the high for the balance of the year. And gold did peak in August and has been off since. And last week, even Bloomberg quoted me in an article saying that gold is at a very precarious place right now. And if the dollar continues to rally, a lot of people are going to lose a lot of money in the metals. And we've seen, gold's off a couple $100. It's also, you have to think of it in reference points to prior highs. Go back to 2011, Then the all-time high in gold was 1924 in the front month futures contract. We're well below 1924 now. So that even though we made a new all-time high, we're back underneath what had been the prior high. So technically, if you take a step back, you could look at the long-term charts and say, there's a possibility gold has a long-term double top. You can't call it yet. We haven't sold off enough. But you should realize that gold is not performing so well. Now, it's always, I believe, you should have a piece of your portfolio in gold because of the hedge factor that it creates. But if you're simply a trader, you're going to make a lot more money in the QQQ being long that than having been long gold. In fact, if you look at the two of them against each other, gold's making new lows against NASDAQ. So if you're just a pure trader and your goal is to make money, you'll actually do much better in other places than gold. Gold has done well for me. I've been long gold for hundreds of dollars worth, so I'm doing fine on it. But if you're a pure trader, don't get stuck trading gold thinking you have to be long gold, even because, Bitcoin's moving up. I don't trade Bitcoin. I don't care about Bitcoin. But pay attention to a dollar rally is going to hurt gold. And that's reality. Everything else being equal, if the dollar surges another % or 2, gold's not going to sit where it's trading. It just won't.
Right. But also, neither is the stock market, probably, since a lot of people are basically assuming hey, the dollar is going to go down long term. There's going to be all this stimulus. There's going to be this low inflation and easy monetary policy for years. So that is sort of the long-term trend, but there are definitely there's a potential for a lot of just these short-term counter moves that take people by surprise and knock a lot of people out of trades and kind of surprise.
Last year, Andrew, the dollar and the stock market went virtually opposite, right? The dollar peaked in March, the same time the stocks bottomed. And then the stocks moved up the rest of the year and the dollar moved down the rest of the year. So in 2020, you had a complete inverse relationship. That's not the long-term relationship between the dollar and stocks. There are certainly times they move in the same direction. But last year, and I've told clients, until you see that unwind, just assume that dollar strength will mean stock weakness and vice versa.
So traders should, be keeping a close eye kind of on what's going on with the dollar, the potential for some surprising reversals and moves there. What other sectors of the market are, kind of looking surprising or, ripe for kind of a big move in either direction that you're looking at right now?
So I like within stocks, I like financials. I upgraded them I think it was December 1st. So one of the reports I write for individual investors and financial advisors is called the 7-Eleven report. And it comes out monthly. And Andrew, what I try to do here is literally create a portfolio of no more than 7 of the 11 spider sector ETFs. So I max out at 7 with the goal of outperforming the S&P. So my belief is, look, and this would be in theory the best thing any portfolio manager could do who's benchmarked against the S&P. Avoid the underperformers. If you think about it, mathematically, if you're not in the stocks that are dragging the S&P performance, you're going to do better.
Right.
So I started this report last August with the goal of outperforming the S&P by being in no more than 7 and no less than 5 of the spider ETFs. All right, so XLE, XLC, XLY, etc. Since that report started, we've outperformed by 2.1% as of December 31st. Doesn't sound like a lot, but if you're a true portfolio manager and you outperform the S&P in 5 months by 2.1%, you annualize that, you're over a 4% outperformance. That's huge. So this model that I update each month and put out to subscribers, it's a 35-page or so report each month, lots of charts. I upgraded from underweight to neutral financials September 1st, and January 1st, we went overweight. So I actually think that financials are a sector to be as an overweight. And that's the first time we've had them as an overweight in a long time. The value of that is that, and how I foresee them going this year is I think rates, which short-term peaked at about the 10-year about, I think, 114 or so basis points, which is also 1.14% for those who don't think in basis point terms. I think they can surprise the market and not only get above what had been all-time lows, which was somewhere around 1.4% until a year and a half ago, but even get as high as 1.8, 1.85 this year or next year. That's a huge windfall for banks and anybody else in the financial space, where the spread between the short end and the long term, essentially the yield curve, the widening of the yield curve is great for those sectors, for especially banks. So I think financials are going to outperform, and that bonds are going to get hit far worse than most people think. So as far as I'm concerned, the bottom in 10-year yields that got down to, I think the lowest low was 46 basis points last year. That is the bottom in the US market. And I do think we will creep back and possibly even surprise people how much bonds could sell off. So if you're a bond holder, which most people are, because you either, traditionally have a 70% equities, 30% bonds, 60% equities, 40%, depending on your age and stuff, I'd be a little concerned about holding bonds, because for 30 years, they've been a great investment. Not only did you get higher yields, but as time went on, you got lower yields. But because bond prices moved up, your total return was terrific, often rivaling and even outperforming the stock market's return on any given year. I think that's done with. If yields go up, bond prices go down. So on the bonds you own already, you're losing capital. And if you happen to have bought bonds when yields were low, and let's say you're only locking in 2.5% a year, you could easily lose that just in the price movement of the bond, which means you actually end up losing money. So I'm not a big fan of holding bonds. Now, certain institutions have to, pension funds have to, insurance companies have to. That's how they create the flow of money that they need to pay off certain policies. But for the average person, I'm not in love with grabbing a bond at 1% or anything close to it, because I think at this point, the chances are you're going to net lose money or just simply not make any money.
Right. And I think a lot of, smaller investors are looking at these returns and they're thinking, okay, if the government wants 2 to 3% inflation and you're going to give me, 1.2% on a 10-year bond, of course I'm going to go into the stock market. Even if I'm buying just like the dividend paying, dividend growth stocks, 10 years, there's mathematically, I'm likely to, not lose money on that trade relative to.
Correct.
But if I go into high growth stocks, some tech stocks, some small cap stocks, instead of making this paltry 2% a year, little risk, big reward. So it does seem like the market is still very lopsided towards higher equity returns this year.
Yeah, it is. If you take a look at the average analyst on the street, or I guess better said, the strategists at the big sell side firms, the consensus is still for a mildly higher 2021. Not a huge one, but mildly higher. And of course, I incorporate behavioral finance a lot into what I do. I was the first to teach it at NYU, and it's also part of the edge I have, because I understand the psychology and how people make their financial decisions and what's the trigger point in making the ones they do. And generally, the strategists on the street anchor themselves near to where the price of the market was when they make their forward call of where the market's going to be the next 12 months. So if the S&P is at 3,800, they'll be a little above, they'll be a little, but it's always somewhat close to the anchored point. And generally, Most strategists are not right. They're off by several hundred S&P points, most of them. Some get it close, but it's pretty hard to find someone who gets it right 2 or 3 years in a row. So I just did a podcast. I do a podcast each week for stockcharts.com, and it's available on YouTube also. That just I think it was 2 weeks ago where I said I disregard the only thing I care about strategists' annual forecast is what are they collectively thinking, and I try to get a sense of where are these consensus calls, because those are the ones that are so often wrong. And that's what I often try to exploit. So I never care what a particular company strategy says where the S&P will be at the end of the year. It's meaningless. They have no idea. They take their models and say, take a look at last year. Did anybody have any clue of what was going to happen in the market, let alone the path that we took to get to the year-end price target?
Oh, the path, no. But people who were saying the market was going to be up last year were correct, but they were wrong.
Yeah, but
they were wrong before they were right. So the person
not only were they wrong, but they were right. They were right for the wrong reason. Right. The only reason the market did what it did last year post-March was because of the Fed.
Right.
And the injection of continuous liquidity as needed, when needed, without any plans of stopping it. That's why the market went up. So COVID ultimately was the trigger point for all this happening. So some people say, oh, COVID ended up being meaningless last year. Well, actually, no. Every bit of stimulus, everything that happened was because COVID is here and killing small businesses and, having people indoors and wearing sweatshirts instead of dressing like you are, because we're not in the office. We're not doing what we normally do. So COVID actually was the biggest contributor to the stock market's rally last year.
Yeah, as opposed to being down 20, 30% or more. I mean, depending on how bad COVID had gotten, all the stimulus in the world might not have necessarily overcome the fear if there had been that. But a lot of people, I think, also overlooked the fact that late 2019 into early 2020, we actually had that yield curve inversion, because you're talking about how it's getting a lot steeper now. And like the market was still going up. The market kind of ignores the yield curve inversion for a few months after it first appears. But it's like one of the most accurate indicators for some trouble. And the fact that the trouble ended up being COVID driven rather than a more traditional economic issue, it's kind of irrelevant to that. I mean, the market actually, it's one area where it's very predictive and forward looking.
It certainly is forward looking. And the more you read the news and the headlines and just how bad things were last year with COVID, and I myself got caught into interpreting just how bad business would get because of COVID. And I wasn't wrong. What I didn't take into full consideration was basically don't fight the Fed. Just how much the Fed's influence of liquidity in the marketplace impacted continuously the buy side. I don't mean the buy side of Wall Street, the bullish market moving higher. So I only put out 2 official buy signals last year. March 23rd, the day that made the low for the year, and April 1st, the day that almost tested the low. Those are the 2 days I said buy. The thing is, I didn't hold it for the whole run. There are a couple times that I suggested hedging portfolios, whether selling futures or reducing exposure, because I thought we had reached the point that we weren't going to go higher. And generally, it cost me about 100 S&P points to get back in to the S&P itself. So, a few percent before I said, no, it's incorrect. You need to be back in. So even though ultimately I ended up outperforming the S&P in the recommendations we made, last year fooled me too. I remember saying there's no logical reason to think the S&P is going to make new all-time highs. So we bought the bottom, but never was what had been the all-time highs my target point. There was no reason to think given what was going on in the world, for the stock market come back and make new all-time highs. It was illogical. And yet that's exactly what happened. And
Well, I
then
mean, big
quite a
market
bit more.
liquidity, a lot of retail traders, just not having anything else to do and, get some stimulus money and putting it somewhere. And, anyone who actually followed the traditional financial advice to buy the dip, they might not have gotten the exact prices, but, they ended up getting a better return than otherwise. So, a lot of, kind of opportunities there. So now the question is obviously like, where do we go from here? It sounds like longer term, steep yield curves, markets can keep going up. Shorter term, got some dollar trends that could lead to some volatility. What are the best ways for investors to kind of play that? What are the best, kind of trends to watch?
So if you're an investor, and when I say investor, to me, you're a long-term, you don't care about a 5% move. You probably shouldn't really even care about a 10% move. You're in it for the long haul. Let's say you're a 30-year-old kid who puts money in an IRA. You're not touching it for 40 years. I'd be generally in the most aggressive stocks you can be in. Because over time, there's no better place to be than the stock market as an investment. So for people, when you're years and years away from retirement, put as much of your salary as you can into a 401, into the plan that your company offers you. And I generally would suggest I wouldn't worry much about putting money on the safe side, the bond side. If you've got 30, 40 years of investing, I would be on the growth side of the market. I would, if they give you a choice to be in let's say the NASDAQ and that type of technology arena, I would lean there. For the average trader, it's a whole different story because your time frame could be anywhere from super short term, which is a tough game to play, to a few weeks or months, and that is an exploitable time frame. If you have good discipline and the proper tools, you can capture interim trends. Right now, we have 3817 as a trading target in the S&P. We got to 3826, so we got 10 points above, and we're told off now a little bit. So I have been cautioning people about being 100% long. If I had to guess where the top would come this year, it's probably between 3,900 and 4,000. That's somewhere right around there would be my guess. But if we look out even a couple of years from now, I think there's a very good chance the S&P gets to 5,000 in just a few years. So unless you have the wherewithal and the tools and feel like staring at your screens, all day long, if you're an investor, use pullbacks of, anytime you get a friend of mine actually told me this, and I think it's a great thing. Every time the market pulls back 5% from a high, he puts more money into his kid's college education fund. If it sells off 10%, he puts more in. Every 5% down, he'll put a certain amount of money in, because he knows over time there's only so much the market's going to pull back before it comes back again. So you could use 5%, you could use 10%, whatever you feel comfortable. But when the market gets hit, generally it's a pretty good idea to buy into the dip and leave some capital in case it falls some more. But for short-term investors, unless you want to stare at your screen all day long, to me, take advantage of the dips and play for a higher move. In 2014, in June of 2014, one of the last pieces I wrote for Wells Fargo before I left the firm, and the S&P was trading at 2,000 in June of 14, was that within 10 years, the S&P will be at 5,000. So I have essentially until June of 24 to see if my call is right. People told me I was nuts, but I was looking at the long-term stuff and came up with, this thing can rally that much more in 10 years. And we're kind of on track for that. If we're near 3,800, we still got 3 years to go, I think we can do it. So I'm still bullish on the market. I'm short at times, But in the big picture, I think stocks, you have to own stocks if you're an investor, and you have to be able to withstand some nasty drawdowns that come every once in a while in order to be in it for the long haul. And it's how you create wealth for yourself. You
Right.
can,
It's
if you
acting
have
in ways
excess
that,
capital,
yeah.
that you can buy real estate, but for the average person, you want to be in the stock market for over time. And that's how you'll create wealth for yourself. Leaving money in the bank at 0.5% is not going to create wealth, especially when the inflation rate is higher than what you're getting in the bank. You're losing money. So yes, there's risk in being in the stock market, but it is the best place to be over time.
And getting comfortable with that risk is, yeah, absolutely an essential, part of investing, and just getting started,
Absolutely.
comfortable, and scaling it up. So do
Yeah.
you want to kind of change tracks a little bit about commodities? We kind of talked a little bit kind of before that. We've got some, kind of comments from our viewers. Nevada copper. We talked a little bit about copper before we kind of went live here. It's something where, you kind of call it sort of a short-term trend. What do you see playing out there?
So copper had a huge run, like the stock market. So it basically followed the game plan of growth, and that China growth, and China is growing, and their stock market's doing well. So even though the COVID virus started there and they got hit first, they've recovered very well. I'm long China in the institutional funds. But from a pure trend exhaustion point of view, a couple months ago, I had said that if New York copper, so COMEX copper, as compared to the London Metals Exchange, got to 373 to 379, that's where I'd want to exit longs and get and short it as a trade. And I still think that that's the right moves, and we peaked just north of 373 and then pulled back into the 350s, and now we're in the 3.6s. Unfortunately for the listener who put in, I'm not going to put out and talk about individual stocks here, except for in an educational point of view, but I'm not going to give recommendations on individual stocks. And offhand, Nevada copper, I don't, in my head, I don't know the chart of it anyway. In general, I think copper has gotten ahead of itself. It should be in for a good pause here. So at this point, I'm not jumping on copper or copper stocks. If you're a long-term player, I'd probably use a dip, because I do think you'll see a dip in some of these names to buy. And over time, it's probably the right thing. But right here and now, I'm not a fan of first buying copper. And if you own copper or copper names, so FCX, that's been flying. But I'm not first buying it now. I'd wait for a pullback. They've been on a surge. Yeah.
Yeah, I mean, a lot of people, I think.
And this is the thing about Andrew, in buying deep. Okay, you go. It's hard. There's a little delay.
No, it just seems like people are front running inflation without really waiting to see if that's going to happen. And we saw this in 2009, 2010, 2011 with gold, where people are like, oh, there's going to be all this inflation from all this money printing. And there was so much fighting deflation in the housing market that we didn't really get inflation. So, I think some people too might want to, bear in mind, you can kind of get these big moves higher, but it might not be a sustained multi-year trend. So go ahead.
Yeah. And one of the things that's hard about buying well into an uptrend is, how do you manage risk? If you buy one of these stocks, again, for educational purposes, let's talk about FCX. I know it just made multi-year highs. I'm not sure of the price, but I'm pretty sure it's already crossed into 30 or something like that. If you bought it now and it fell, let's just say it's trading at 30, whether it is or isn't. Let's just say it is. If it falls to 26, do you stop yourself out? Or is 26 really the better place to get in? To me, it's very difficult when you have a strong uptrend and you buy in that strong uptrend to manage risk. Because at what point are you wrong? If you pay 30, do you let it go to 22 if it corrected that far? So at some point you're going to puke out of it and say, oh my God, I can't believe I lost in this. Right. And you're probably selling it where it's really a buy. So maybe you will put a little bit, if you had X amount of dollars that you want to put into a particular stock, maybe you put 20% of that in case it keeps going. So at least you have some exposure. But leave the other 80% for if it pulls back, so that you really can get in at a more favorable price than simply buying because on TV news and CNBC and Fox and Bloomberg you hear, oh, some stocks making multi-year highs is on a breakout. Yeah, it might be, but people have anticipated it also. It's all part of the game.
And I mean, when you're seeing that on the financial news, it's almost like it's encouraging kind of these small investors like, oh, hey, look what you've been missing out on. Let's get that FOMO. And then they start buying kind of at these highs. And that's, those are the people who are going to be frustrated at the first small pullback, because for them, that's wiping them out. But, the guy who got in a year ago, like it's just part of the ride. Yeah. We have another viewer comment. Lithium for the 2020s. Love the time frame on that, a whole decade out. Since you've kind of been talking, about your, 10-year S&P 500 prediction, it does seem like electric vehicles are just kind of at this cusp on that S-shaped kind of growth model where it's just that rapid adoption. Lithium's a big part of that. I mean, is that a space that's likely to kind of also see that short-term pullback, long-term zoom?
I think over time, it's also jumped up significantly, but I think over time, as you shift away from let's call it older technology in the energy space and move more towards clean energy, the things that are going to be used in clean energy vehicles and heating components and anything that comes down the line technology wise is going to be the growth part. And the stodgier, older type firms that don't change with the times are going to see their stocks underperform. You've seen solar stocks and ETFs just fly. You've seen clean energy names. We had clients in the No Trader, the retail investor newsletter. We had them in PBW, which was one of these clean energy names. We got in at 30 and we scaled down, and the last sale was at 92. I mean, so some of it we tripled our money on. Now it's at 110, but I was content at getting out where I did. I had exhaustion signals.
Right.
There's a point where I'm just not going to keep sticking with stuff.
I mean, it's tech. If it hits sort of an air pocket, it can go back to 75, 80 pretty quick and still be in that long-term uptrend.
In a second.
Yeah.
Exactly.
So, I mean, that's a good spot to be in. I've got another comment coming in from a user on fusion energy. Any thoughts there? I think that's still pretty kind of on the drawing board, or feels like it has been for years.
I don't know much about it, honestly. It sounds like it's kind of new energy as compared to old. It sounds maybe, I don't know if there's any nuclear piece to, when I hear fusion, I kind of think of nuclear fusion, but right. I honestly know very little about that. But from investors' point of view, it's hard to think why old energy is going to do as well as new energy as time goes on. But again, you want to buy after you've seen an air pocket on the downside. At some point, something's going to make these names just drop quickly. And when I say quickly, it could be 30% in a week and a half.
Right.
And then the news stories are going to come out about why it's terrible and what, that's the time when you step in, to me. And maybe it sells off another 10%. But if you're investing for the long haul, that's what you do. You take advantage of other people's panic.
Right. I mean, I saw some articles on Bitcoin being dead when it dropped from 40,000 to 30,000, but it went from 4,000 to 40,000 in a year on all the, Fed fear, money printing, all that stuff. So same principle, it seems. Kind of coming up on the top of our hour here. Any final thoughts? Any other kind of, here's kind of the most unique, investment idea that you think, people should be doing some research on, taking a look at?
Yeah, let's see. So one of the things people keep asking me is about energy, because right now it's this year's best performing sector. The thing is, the energy sector only makes up 3% of the S&P. So even though it's outperforming everything else, it's a tiny piece of the S&P. Technology and consumer discretionary and financials are much, much more heavy weights in the S&P. But they're saying, stocks are flying. Should you get in? So I own some, we talked about this publicly. So in podcasts, I own some Chevron at 75. I was kind of bottom fishing, and I had to probably deal with about a $10 decline, but now it's in the 90s. And I own some XOP, which I also bought early and had to watch it fall probably 30% before. Now I'm making some decent money on it. I haven't upgraded energy yet in the fund. In other words, in that 7-Eleven fund, we do not own XLE, and yet we're still outperforming. But I have to start looking. I can't buy anything that's got an underweight to it. And so far, it's been an underweight for a long time. And it was not only last year's worst performing sector, it was 2019's worst performing sector. And it's the worst performing sector in the S&P for the last 20 plus years. So you've made no money in energy if you've been in the XLE relative to the market for the last 20 years. So the worst place to be. I'm starting to look if there's any signals that really get me, compelling signals to really put some serious money in there. I haven't gotten there yet, but I'm probably close to at least taking it from a long-term underweight towards more of a neutral type position. I'm not going to rush into these names now because oil to me at $52 a barrel is crazy. It's crazy. So I think this energy move is fairly short-lived. It doesn't mean it can't last a few more months as funds that were not in it are coming back in. But I still can't make the case for significantly higher oil. And if it's not, then the bulk of the energy space can't significantly, progress.
Right.
So that's something that I don't want to get caught into that game. I downgraded communication services, which like Google and Facebook are the biggest components of XLC. And so I actually have a pair trade on long financial, short communication services. That's working nicely. I'm just trying to think if there's any other like kind of bigger macro themes. So, bond yields higher and possibly more than people think. Financials is definitely an overweight in the sector place. Communications as a neutral and as a pair trade against XLF, and not to get really, I'd say, hooked into the energy play just yet.
I mean, it's an interesting space because if the economy is recovering, if demand is driving up, you've also got kind of OPEC and Russia working on production cuts. There could be a big move, but it also feels like a big chunk of that has been priced in at this point.
I look, honestly, I've missed the bullish oil move. I can't, and I'm always more on the technical side than the fundamental side, but I have enough contacts and people I talk to. I can't fundamentally make sense at a $52 oil. I couldn't even make sense at a $40 oil. There is so much oil. This, a lot of times these are driven by the paper markets, the futures markets, and all the funds that get buy signals just push markets, and they can push them for a long time before the fundamentals really change, or not change, but kick in enough to say, all you people who are long oil, okay, now who are you going to sell it to? And then it becomes, there's nobody left to buy. There's no one I talk to who can make sense out of oil being at this price, let alone oil at 40. So I'm short oil. I trade for a fund. I'm short oil right here at 52 and a quarter. It's where it's trading right now. I didn't care last week that it went $1 against me. That's nothing. I can easily see $45 oil because it shouldn't be here. And it's so priced in demand coming, and yet we're all still sitting at home. We're not going to the office.
Right.
We're not driving much at all. I mean, my car sits on the driveway. My lease is up in June. And I said to my wife, why should I even keep driving such like an expensive car? I don't go anywhere anymore. What's the use of having, a $400 a month lease payment on a car that doesn't go anywhere? So I can't wrap my hands around $50 oil. So I'm short here right now.
Makes sense. All right. So coming up on the top of the hour, you've mentioned In the Know Trader. You've mentioned your YouTube channel, your podcast. Any other places where people can find more about you, kind of learn a little more on kind of your...
Sure. So In the Know Trader for individual investors, go to the website inthenowtrader.com. If you're institutional and you're watching this, check out Bensignor investmentstrategies.com. And you'll learn a lot more about what I do for institutions and all the clients. Well, you won't know who the clients are, but I consult to some of the most continuously successful hedge funds in the world. And they pay me because they want access to me to know when a trend is likely changing, whether it's in a macro sense or I review their individual portfolio too. I'll go through their top 20 names quarterly and give them the key levels to be paying attention to. And I'll monitor them myself. So I'll proactively pick up the phone and say, hey, look, you're long XYZ. It's, I think it's exhaustion. You may want to lighten up here. And that's the type of work I do. So those are the two places. And then every week for stockcharts.com, I do a podcast. On Tuesdays, it comes out 3 p.m. in the afternoon Eastern time, both on stockcharts.com, live on their channel. And then it's also available YouTube on demand.
Oh, perfect. All right. Rick Bensignor, thank you for your time today. And thank those of you folks here.
Thank you, Andrew.
Reporter. Yeah, absolutely. Enjoy the rest of your Martin Luther King Jr. Day. Be well. And until next time, I'm Andrew Packer, signing off.